Yeah, so I guess it's best to start with definitions. And so I've done a lot of research showing how price inflation correlates with increases in broad money supply, although there are some exceptions. And so generally, there's monetary inflation, which is just an increase in the broad money supply, especially on a per capita basis. Then you have price inflation, which is basically the prices of things, usually commodities, but it trickles up to everything else, prices, wages, things like that going up. And then you have asset price inflation, where if you have a lot of money supply growth, but you manage to keep, say, commodity inflation low because maybe there's a lot of commodity abundance at that time, then that can instead translate into asset price inflation, where we pay more for the same stock. Basically, we're paying to pay more for the same stream of earnings in a stock than we otherwise would. And basically, it can kind of cause bubbles in financial assets. And so, the last decade, we're at the stage where monetary inflation was moderate. It wasn't low, but it wasn't super high either. And because if you look at broad money supply rather than just base money, so a lot of people look at the base money charts and it just goes like parabolic, but broad money supply was growing at kind of a moderately high pace. And because we were in a period of commodity abundance, a lot of that increase translated into asset price inflation instead. But now, as we go into the 2020s, money supply growth has accelerated in many parts of the world, especially developed markets who've had more kind of fiscal space to do some of the fiscal activities they wanted to do, with the United States and Canada being among the highest in terms of, say, year-over-year percent change in broad money supply. And because our commodity markets are a little bit tighter than they were over the past decade, and because of this how quickly M2 is rising, we're starting to see bottlenecks in different sort of supply chains or commodities, and so that translates more towards actual price increases, where commodities go up, wages can go up, and basically shipping costs can go up, all sorts of things can trickle through, and you find yourselves with these periodic shortages. And so generally what you see is that the past two inflationary decades of the past century were the 1970s, the 1940s, and if we go back further than that, we can find the World War I inflations. Like the United States had big inflation in the the 1910s, and of course Germany had the big hyperinflation in the next decade. But if we just look at the past two ones, the 70s were characterized by rapid increases in the broad money supply and an oil shock, so an oil embargo. And so that caused that combination of commodity scarcity with rapidly rising money. And then the 1940s, of course, you had fiscal-driven inflation, and you had various commodity shortages related to the war. We even started making pennies out of a different material because we needed the normal material for the war effort and things like that. Basically, all the little details you need to get all the commodities you could. And so what we find ourselves in the 2020s is that money supply is going up at the fastest rate that it's gone up since World War II in many countries, with the United States and Canada kind of leading the way in terms of that percent change, while at the same time we're facing semiconductor shortages, shipping container shortages, things like that. And of course, because semiconductors are used in so many things, that trickles into used car prices and all sorts of things like that. And so my overall base case in the 1940s, in the 2020s, is it looks somewhat like the 1940s in the sense that you have these periodic spikes of inflation based on fiscal expansion. So based on fiscal-driven money supply going up, which means you're running large deficits to basically pump up the money supply, which is different than, say, the 1970s, which is more so bank lending based. And so if you look at the 1940s, you had three really big inflationary spikes. And you could call them transitory in the sense that it didn't keep. It's not like inflation kept just getting worse and worse and worse. It'd have these really big spikes and then it would calm down. However, it never like those prices never came back down. They just kind of went up and they had a new plateau, and then they went up again and they had a new plateau. And I see the 2020s playing out similarly, where you could have these periods of inflation that reach some eye-popping numbers compared to what we've had in the past 10, 20 years, but then they cool over and some of those bottlenecks get resolved, but then if they do another big round of fiscal stimulus and kind of the next cycle, you can get another spike in inflation and that can cool off, but each time the prices in general are just kind of hitting new plateaus. And there's there will be some areas like, say, lumber, that get really silly high and they'll come back down, whereas if you look at like a broad set of prices, those will generally be elevated after each one of those bursts of inflation.
Well, it's I mean, you already talked about the definition of inflation, but it seems to me that some institutions like central banks or other economists we witness an inflation of theories of inflation.
Well, yeah, basically everyone has an idea of how it works. And so that's actually, I wrote like a recent article because I wanted to find correlations and find causes and kind of look through the history books and find out, where it comes from. And basically it's one of those things. There's that parable of like three different people are like blindfolded and they're touching like an elephant, and they're all touching like a different part. Like someone's touching the tusk and someone's touching the ear and someone's touching like the skin, and they're all describing something that sounds totally different, but really they're just each describing a small part of what it is. And so I think that's the biggest risk that economists or forecasters have, is that they can be wrong without they're what they said might not be wrong, but it's just incomplete. And so that's always kind of the most challenging part of economic forecasts, is that one or two missing variables can change the direction, even if like say the 5 variables you were looking at ended up being correct. And so I think it's really important to step back and try to have the biggest possible umbrella framework, and then kind of monitor that going on, and then test it. Like basically see if it's playing out the way you thought, and if it's not, then you quickly back up and say what variable am I missing, what is deviating from what I thought, and how can I adjust to compensate for that. Or if it is working, then that's a good feedback for the theory, and then you just got to keep monitoring to make sure things don't change.
So if I take your analogy further, would you say that the ones that are basically the pilots and behind the wheel of all those institutions like central banks and also like governments through their fiscal policies are actually blindfolded behind the wheel?
I think partially. Yeah, I think they have some of the answers, but not all the answers. And so if you look at their meeting minutes, I mean, they're often, kind of figuring things out like anyone else is. And kind of just saying like, we don't know how it's going to play out, but here's what we're thinking. And so I think it's also one of those things where sometimes they know more than they let on, because there are certain things you can't say kind of publicly, because it's somewhat of a political role. It's supposed to be independent. There's still a political element to it. And so kind of like how politicians don't necessarily say what they mean, you have kind of a similar situation with central bankers where they don't want to be the cause of things. So they don't want to, if they talk about high inflation, that can be self-fulfilling. And so they always are kind of playing things down and kind of looking towards the median, rather than kind of stoking up whatever extremes that things could go in. They're always trying to kind of push back to that middle.
Yeah, it's for example, when Jerome Powell says we're going into temporary inflation, he's not going to say, "Hey, markets, please panic. We're actually into inflation." So that's pretty obvious. But he also, in the meantime, is kind of like burying down Milton Friedman by saying that supply has nothing to do with inflation in one way or another.
Yeah, I think that, I mean, it's tough because we had this big M2 spike, this big broad money supply spike, and so if he were to say that that's highly correlated, well, then that's forecasting a very large inflationary spike, CPI spike, and so and some of the models I've seen are looking at the potential for high single digit spike of inflation before kind of cooling off, and then it depends on what happens next with fiscal policy, but basically if you look at the very long run. If you have kind of especially multiple years in a row of rapid broad money supply growth, that tends to pull up broad prices unless you have some really big deflationary force that's pushing prices down. And so, for example, in the United States in the late 1800s, they they had all this kind of land that they expanded into. And so they basically did not have this limitation of resources. They were able to expand, and so broad money supply could grow pretty rapidly without causing price inflation. You also had, for example, oil made things a lot more efficient. You had railroads come together. You had internal combustion engines. You had electrification. And whereas, for example, if you look at the UK, they were a little bit more constrained because they obviously, they had limited land. It's already, mapped out at that point. And so they didn't have this kind of abundance of resources. And so theirs was more correlated. Their money supply versus inflation was more correlated during that period. Similarly, in the past 20 years, we've had a wider than normal gap between broad money supply growth and CPI.